Good morning, ladies and gentlemen. We're back with another episode of Beat the Bell. Happy Wednesday, happy hump day. And the markets are still feeling some of this turmoil we've been seeing as of recently, still feeling like the bears are getting the best of the bulls as of late. And to discuss it, we'll bring in our panel, starting with Noah.
Mander, what's going on? Like you said, pretty muted price action throughout the week, flat to red. We'll dive into what could be leading to that and what we have up next.
All right. Stock Snipa.
Good morning. Let's get to it. Got some cool questions today.
And last but definitely not least, we have Matt on the panel yet again. Trader's Paradise with Rocket Scooter.
Hey, how's it going, everybody? Good morning. Thanks for having me.
All right, so we'll get back to Matt in a second. We'll give him the chance to discuss what Rocket Scooter is showing. But first, we'll start off here with Noah and I for Fed forecast.
Yeah, let's kick it off. Let's kick it off with the economic calendar for today and the rest of the week. So today we've got building permits that just came out at 8:30, as well as housing starts. The real big piece of news today is going to be the FOMC minutes release at 2 p.m. this afternoon. So definitely keep your eyes out for that. And then tomorrow we've got the Philly Manufacturing Index. Hopefully Sal is okay with my spelling there. And then we have the weekly jobless claims coming in tomorrow as well. Today, building permits came in at 1.44 million versus 1.46 expected. So more or less in line. Housing starts 1.45 million versus 1.44 expected. So more or less in line with all the morning data so far. From the U.S. standpoint. Let's talk about this week's trading so far. As Mander talked about, it's been a choppy week of trading, basically keeping pace with what is made for a choppy month. So yesterday, the market fell yet again with the Dow, NASDAQ, and S&P falling 1%, 1.1%, and 1.2% respectively. A hot retail sales print that came in at 0.7% growth month over month versus 0.4% expectations showed that the U.S. consumer is still strong, a prospect that could lead the Fed to extend its elevated interest rate regime longer than previously anticipated. The news sent yields soaring as bond prices fell, pushing the benchmark 10-year Treasury yield to 4.264% intraday, the highest level since 2008. Yields are important because of how they affect the equity risk premium, in part because of how they affect the equity risk premium, which is the gap between the S&P 500's earnings yield and the yield on the 10-year treasuries. The lower this premium, the less attractive stocks are relative to bonds. That earnings risk premium that we've hit on the show before reached its lowest levels since 2003 recently, so the lowest level in about 20 years. So stocks relative to bonds are at their worst valuations in over 2 decades here. It puts the market in a precarious situation as we near the end of earnings season. Even as many companies are topping expectations, valuations are becoming more difficult to justify given the lack of, and in some cases, negative forward guidance. According to Eric Ristubin, chief investment strategist at Russell Investments, we're pushing some pretty sporty valuations on a pretty significant section of the marketplace. There's a point at which better than expected doesn't mean good value for the future. As we head into the end of August, investors and traders will certainly be focused on Jerome Powell's Jackson Hole comments, which will come next Friday. Last year's symposium caused a sell-off that brought the S&P 500 to fresh lows and took 10 months to fully recover from. So even as we're trading throughout this week, just keep in mind that we do have probably the biggest catalyst of the month coming up just next week here, which could definitely paint a very different picture by the end of next week. So just keep that in mind. Mander, what do you got?
So I was watching CNBC yesterday, and I thought it was kind of funny how they always try and paint the narrative to what price action does. So one of the guys I heard talking, they were going over the retail sales print that came out yesterday, obviously showing the strong consumer. And one of his takes on why the market was down was that because they spent so much in July, they're going to be spent out for August. And this came in because it was hot. This is bad because consumers spent all their money last month and are now not going to spend next month. Really, what it is obviously yields, and yields were the talk of the town yesterday. That's the biggest story I think coming out of yesterday, and really probably the past week post China news that we covered. It's really this yield story, and I think that the retail sales number is probably what sent the big spike in yields here, just because of the strong consumer. But I think kind of looking at this versus stocks, it's not the same story that we had going back to October when we were at these highs previously. And I think you hit on this obviously the big thing here is the equity risk premium, and Fitch and Moody downgrade to treasuries. Economic data out of China showing China's having a really tough time right now. The world's second largest economy, kind of struggling right now. At the surface level, I think it's easy to say yields go up, stocks go down. And I think that's really what we saw last October when you had that fear trade kind of going around the Fed's unprojected path moving forward. Investors were really getting fully risk off from both equities and treasuries. But kind of right now, I think the story is going that right now yields are just pricing higher for longer thanks to the resilient economy. And that's what I think sent them spiking yesterday, is that continually we're seeing the consumer be strong. We saw retail sales almost double expectations yet again, and unemployment continually comes in unfazed at like 3.4, 3.5%. Really, I think this is solely pricing a higher for longer narrative versus more so a recessionary, fear trade that we saw before. And really, we're just getting back to normal. So everyone's looking at this 4% threshold on the 10-year as like the do or die spot to be. And the 10-year goes above 4%, you got to get out of stocks. Really, 4% was always like the golden rule in the 10-year, where you had a 4% on the nominal in the 10-year, and then 2% inflation, bringing your 10-year tips and your treasury, your inflationary protected ones to 2%. And that was always like the golden standard. Right now, you have a 4.3% just about 10-year. And you have a 1.9% return on the 10-year tips, kind of showing a 10-year forecasted inflation at 2.4% right there. So really everything is kind of all in line for what you would see historically. I think everyone just got so used to zero ZERP and 0% interest rates and free money for the cost of, the better part of 2 decades, that now when we get back to this normal, it's seeming like this is a horrible spot to be for stocks, but this always was the normal. And if you go back to the 80s, this is really what we had before. You had more elevated inflation for a longer duration, but that didn't mean you had yields up higher for a longer duration, kind of what we're seeing right now. That didn't mean that stocks did poorly. The 80s were a great time to be invested. So I think if anything, as we have up right here, the higher yields are definitely going to hurt more so on that growth end of the spectrum. On those small caps, those high betas, they're more heavily leveraged. And so that's obviously the increased cost of capital and the increased cost of debt is going to affect them more. But you're already seeing that in the bottom end of the Russell 2000 is obviously where the weakness has been. You're not seeing the big rallies out of the hole in them quite yet. But I think moving forward, if the narrative is yields are higher because the economy is so resilient and we're going to see a higher for longer narrative, I don't think that's intrinsically bearish. I think that just shows that there is still growth to be had in the economy. If anything, that's why we're going to be higher for longer, is GDP is still going to be growing. And that isn't intrinsically bearish to me. I think if anything, that stems this little pullback we're seeing. But I don't think that necessarily means we're going to see a massive corrective move like some people have been calling for, right?
My mic's muted. Am I muted?
No, you're good.
Oh, keep saying I'm muted. To your point about like not necessarily being like the worst time to be invested, I think that a good sort of reason for that as well is like when you look at the actual like fundamentals of it. If you're a newer company, trying to make your way, I think that you have to be right now a lot more stringent in how you're executing, especially like you said, with the cost of capital being so high that all it does is it sort of weeds out the companies that are sort of lackluster, and it really puts a spotlight and you're going to shine if you're able to execute in a relatively difficult environment relative to the last 10 years, right? Like some of the greatest companies that we have today were really built during that like .com bubble when things really weren't looking great. You were forced to execute during that time. And if you couldn't, you died. And if you did, you survived. And those are the companies that ultimately led to our mega caps today, right? So it's not like you said, like sort of the worst case scenario in the world. I think that it increases the level of competition, right? Which is, at the end of the day, always a good thing for both consumers and investors, right? I think, for investors who make smart, wise investment decisions, I'll say, right? Because it's very easy to, when interest rates are at zero, take a flyer on something that you think could be, successful in the future, and cost of capital is low. Maybe this company will execute, maybe they won't, and they're more a product of the whole rising tide lifts all ships sort of phenomenon, as opposed to right now, if you're not able to execute as a young company, you're just not going to survive point blank, right? And so I think that, to your point, that's not necessarily the worst case in the world. That'll wrap it up for us here at Fed Forecast. I guess I'll pass it back to you.
All right. And I'll be passing it right back to Matt. I think this is a great segue because now he can take it and show what are institutions making of all this and where are we kind of looking at on this pullback right now for positioning and where the markets could be heading soon.
So that was a great presentation, by the way. I completely agree with everything you said. Market has actually shown a little bit of a corrective pullback, but I don't think it's going to be as devastating as people are saying that it is. Obviously, my tone changed. Earlier in the year, I was very, very bullish, as all the positional data showed bullishness. I'm going to pull the SPY up really quick. And ever since we got that Fitch downgrade, I think it just kind of slapped some sense into everybody. And what was a solid bullish position? We just look for this dark gray area. And when price is inside of this gray area over time, the market sustainably stays bullish. Right after monthly expiration, right in here, there is no solid positional data to support a continual bullish wave. We're going to have to see what happens after monthly expiration. But this actually could present itself as being the top for the quarter. Now, the volatility isn't present, and for the reasons you did state fundamentally, right? The GDP growth is positive, jobs data is looking better, retail sales, all these things are starting to look up to show positive growth in the economy. So I think that's going to be that resiliency that's keeping the market from crashing. But of course, the lack of market breadth, like you guys mentioned, is what's keeping the market from flying up higher. Most of this rally was sustained on like a few sectors, and so now we're just going to see, I think, a slow trickle, gentle drift down. It kind of looks like we might actually have the ability to squeeze and pop into monthly expiration. But then after that, it just kind of looks like we're not bullish, not bearish for a while. I think the market's going to sustain a period of confusion. See how it looks like you just threw a rock into a glass wall and it shattered. I mean, it used to be a defining bull and bear split. You can see it was very easily bullish and bearish. So this is to show you that catalyst that we had, that event was the event to shake the market up. And same thing looks the same in the NASDAQ. So, comparing, since the majority of the tech move was based on the tech rally, and the NASDAQ has that same look. I mean, for about a week or so, it still sustainably stays not crash worthy. But I think after this, you have to go through monthly expiration and see what people think. It's a brand new month. We just rolled into a new VIX month. So the contract rolled over this morning. There's a little bit of contango built into it. And VIX futures trading in 18 right now, which is something to take note of because 18.5 was the highest it was last month. So we're already opening this month at a somewhat elevated volatility. So after we get through monthly expiration, it could be a really very interesting start to a possible volatile month and possible pullback. Now, again, not bullish, not bearish at this moment. I think the market's just going to gently trickle lower. And positionally, the data supports that. And if you have the commitment of traders as well, this is in the futures world. Positionally, this is what I look for to get a handle on how markets are positioned in the futures world, and this risk usually mirrors the risk in the equities world. The asset managers have been selling since the end of July, so there's a little bit of a dip in this little green line. The net long position is trimmed a little bit, and this could just be healthy profit taking, right? And of course, you can see that the short position, the leverage fund, has actually been covering. So you have short squeezing and long selling at the same time. Buyers and sellers are actually finding each other, but while both sides of the equities market are exiting and moving into the fixed income market, like you said, this is a remnant of people just leaving equities in general, both sides. So bulls and bears finding each other is actually keeping the market from collapsing on itself, just positionally. You have the blue short covering into the green selling. So all in all, I think that this week's going to be relatively mild. We're going to get some probably activity going into the following week after monthly expiration, and then it's basically up in the air from there. But as of right now, my strong bull sentiment from last a couple months ago, leading up into that rally lasting until October, I've kind of trimmed that back to saying that monthly expiration is going to probably be that pivot where we see the high for the year, unless something changes. Now, fundamental data still looks good, so I think there's going to be a dip that people are going to buy at some point that's going to wave this back up. It's just hard to tell where that is right now.
That was awesome. I think that's really interesting to see as well, right? When you noted that kind of those catalysts that came out with the credit downgrades, you can immediately see that reflected in positioning. Because I remember when you were on here a few weeks ago, it was a totally different map being painted, even just a few weeks ago. So I think that's really cool to see that you're able to physically see how positioning is changing as these events kind of unfold.
It looked absolutely untouchable. I was so confident in it, and that one event just shattered it. And so it's kind of like when you're using positional data, you get a real view of the sentiment of how traders are actually responding to something. Was this event bad enough to change a sentiment? And then as soon as it does, we change our tone. Absolutely.
Mm-hmm. As traders, that's all you can really do, right?
Respond. Yep.
Respond. All right, let's send it over to Stock Snipa. He can lead us off here with Bet the Bell.
Good morning, guys. Got a cool segment, the best segment of the show. Everybody knows it. Nobody says it. Really excited to ask you guys some of these questions, but let's take a look at the standings right here. We can see that Diamond is continuing to hold the lead right now, 64% win percentage. We can also see that Mander is behind Hondo now, but everybody's creeping up. Things are starting to look pretty good. Mander has now surpassed 60% wins. I put myself on the bottom just to be humble. Everybody knows that too. But let's go ahead and dive right into the first question we got for the day. Green or red? What do we got today? I'm going to start this one off with Matt.
Today, I think today's probably going to be red.
Red? I like it. Mander, what do you got? Green or red?
I was also going to take red. I think it's a tough one. Futures trading just about flat the last I checked. I was kind of just looking at the futures overnight session. Noah hit on this as well. We got some built up equal lows setting down there that I think probably gets pushed through in the morning session. So I'm going to take red.
I like it. Diamond, what do you got?
I agree with Mander. I definitely see us trading lower into like the 44, 45 level on ES. My only thing is that with the FOMC minutes release at 2, you might get some late day action that might save the bulls. But I'm going to go red. I'm going to go red for now.
I'm going to have to take red as well. Red across the board. Bring in the hammer. I'm going to dive into my next question, which is a pretty interesting question for you guys. But do you guys think that Threads will be removed from the App Store within a year? We can notice from a tweet from Unusual Whales that Threads has recorded 576,000 active users in August, which is down 79% from their 2.9 million in July. And we can notice that even before that, I can't remember the number, but they're consistently red every single month, losing lots of users. So I'm going to go ahead and start this one off with Diamond here. What do you got?
I think for Threads, it's a little bit weird because it's not like organic user growth. Like if you were to start like a new app, it's more like you're starting with a massive Facebook's or Meta's massive base of users and then sort of going from there. So it's like a weird situation for them. I don't think it'll be removed from the App Store. I just don't think it will necessarily do super well. I think it'll still be there though.
Matt, what do you got? Will Threads be an app in a year from now?
That's a good question. I've been watching the trends of that too. It just doesn't look like it's going to survive as a valid social media platform. I think everybody went and made their accounts, just like any new social media that pops up. Every influencer in the world wants to be first. First is always the best. But then I think the lack of activity just kind of had people return where they started. So I don't know if it's going to disappear from the App Store, but I certainly don't see it as something that's going to be the next big thing or probably even a thing at all. It might just slowly die out.
I see. Mander, what do you got?
Yeah, Threads is dead. I don't think it gets removed from the App Store, especially because it's Meta and they have the capital to back it, even if it's not really turning over a profit. But you have to think the thing with this one is it was directly tied with Instagram. And so really the people that were transitioning over to Threads were Instagram influencers who more so have their following, either you're good looking or, you post visual content versus someone who has a great Twitter, you're posting engaging text content. And so I really don't think the spinoff was there, right? Everyone made their account and linked it to their Instagram. Clearly it didn't take off.
Yep.
And so I think, Twitter, obviously, or X or whatever we want to call it now, I think that is seemingly here to be the one to stay.
I like it. Yeah, I think X is definitely going to be the one to stay. I think that, in my opinion, personally, right, I think Threads will be gone from the App Store within a year. The reason why I say this is because I think now we're at 576,000, down 76% from the previous month. I think that if we could see another bad month like that, Twitter or Threads could be down to sub 100,000 users per month. and you think about the total users, right? 100,000. So like, what would some of the most popular thread accounts get? Like 5 likes or something, if the 100,000 across the entire app usage, that's like every community, including in the app. So I could totally see them being unlisted, actually. So now I'm going to go ahead and jump in towards this next question. If you had to pick one sector, and keep in mind, I'm saying sector as in if you wanted to pick semiconductors, you could pick AMD, NVIDIA, you could pick all of the companies in that sector. If you had to pick one sector to invest all of your money in for 5 years, which sector would it be and why? I'm going to start this one off with Diamond.
You're talking like S&P sectors or like subsectors, like the 11 S&P guys is what you mean? Like technology, communications.
Yeah,
that's
I
what
was
we'll,
referring to 11, but
that's what we'll use. Obviously technology. I mean, you got to take XLK in that situation. I just don't think like over the next 5 years, I feel like, it's almost like it's like QQQ over SPY. Like, you know what I mean? Like in the short term, we'll definitely endure more volatility. But if I can't sell for 5 years anyways, I'm going to take tech.
Okay.
For sure.
Mander, what do you got?
I'm going to take the same one. I was trying to craft up like a really cool response to this one with either like materials or industrials and have some argument behind it. But realistically, I would have my money in tech.
Okay. Matt, what do you got?
Same thing. I mean, it's obvious choice. I mean, there's a tech bubble. I mean, a tech bubble that hasn't formed yet. There's a tech boom right now that's starting. The AI craze has immediate utility. You have to think about the last .com bubble where stocks didn't have utility, and yet they still, the S&P tripled during that run up from the 80s until the 2000s leading into that. Just imagine AI right now is writing content, writing movie scripts, adjusting everybody's faces on Instagram. I mean, it has immediate utility, even novelty like that. But imagine where it's going to be in 5 years, the acceleration of all the stuff in that sector. And companies like NVIDIA and others are going to end up being the top stocks in the S&P in 5 years. 100%. NVIDIA will be number one.
I like it. Yeah. So wait, are you taking semiconductors or are you taking technology?
XLK all together, not just the chips, but the technology and the other technology companies that would spawn out of the AI craze. There's so much that can come out of that. So tech in general.
Yeah, I was going to bring up AI. We have a lot going on in that space, and we're unsure of right now where it's going, but there's a lot of good talks on AI. I could definitely see that blowing up within the next 5 years. And I mean, information technology is definitely already proven its thing, just with companies like Zoom, many companies in the past, so yeah, I think I want to say information technology, but then you could also take energy, but there's plenty of different options, but overall, I'm going to have to agree with everybody else, and I'm going to have to take technology. I'm going to transition towards my next question. This one's a little bit off topic, right? But just curious to hear what you guys would say. If you could travel anywhere in the world, expense free, for instance, no flight, no stay, you don't have to worry about paying anything, right? Where would you guys go? I'm going to start this one off with Matt.
Anywhere in the world and no restriction. I'd go to Antarctica and like the restricted areas, like the places that no one's allowed to go to, because I just want to come back with information and tell you guys what's out there. Aliens, mutant penguins, who knows, right? We'll see.
I like it, dude. Didn't see that one coming. Good answer. Diamond, what do you got?
That is a good answer. I will go with Bali. I'm gonna go with Bali. I know Bali's not like a super expensive place to begin with, but I don't know. I've been trying to get there for the past couple of years and just hasn't materialized for whatever reason. So I think that's the one I would pick.
I'm going in December, actually.
I might have to slap you.
Mander, what do you got?
So
been to Bali already. He's been to Australia. Mander's been everywhere.
That was mine, and I would 10 out of 10 recommend it. So the ones left, I'm not really like a big bucket list guy. Like I don't have that whole Europe trip fever and everything. I think I would want to go to Singapore though. Singapore looks like an unbelievable city that has a lot to do. And so I think if I was going to take a dream travel anywhere, that would probably be number one right now.
Singapore, I like it. Didn't see that one coming. But yeah, that's a cool city to go to. Now I'm not even sure what to say, man. I probably would go to like I probably go to Japan. I feel like that's just a cool spot that nobody's mentioned. But lots of cool places mentioned here, especially Matt with Antarctica. But that'll wrap it up for Bet the Bell today. I'm going to go ahead and pass it back to Money Mander here.
All right, real quickly, one last segment here. We're going to do a market moron for the week. Ryan always keeping us engaged here with some TikTok content. So I actually ran the math on this one, and the math did add up. At first, I was thinking this was going to be really funny because the math didn't add up. But basically what this guy was saying is the power of 10% profits trading. Start with $1,000, trade only 3 times a week for each month. Full position everything, full port, and shoot for 10% profits. And this is what you could make if you never had a single losing trade and you full ported your entire account shooting for 10% gains. So money and gains isn't your problem. It's your mindset and consistency. So we should all shoot to never have a losing trade on our full port and only shoot for 10% profits. What do you guys make of this one?
Yeah, I mean, I honestly, that strategy was great. I need to adopt that. That don't ever lose a trade. I don't know why I didn't think of that. What a great idea. I'm gonna start that today.
I think every single, you're not a trader if you haven't done that math out on paper before, just to like see what it would be. I think that anybody who's traded longer than a couple months knows that's not realistic, obviously. But look, if that guy figures out how to do that and never take a loss again and just full port every trade and win, then I'm gonna have to sign up for his course. So we'll keep tabs on him.
Dude, the creator of this has got to be some kid with like an $800 trading account that just likes to pump out TikToks and try to get the inside scoop on stuff and attention on stuff, that realistically thinks that this is possible. You know, definitely an airhead that's absolutely making this.
I think the funny part is too, if you're only shooting for 10% profits, like, you know how hard that is to keep a positive R, especially in options trading. If you're only shooting for plus 10%, and that your down draw would have to be 5%. And so tell me how you never have a losing trade with a 5% down draw.
You might lose 5% just exiting that trade with the liquidity.
That's the spread. That's the spread.
You might lose 5% just reading that TikTok.
Yeah, actually.
That'll wrap us up here, guys. Great morning episode here. Thank you for tuning in. The three of us, Snipa, Diamond, and I will be trading live in King Capital. Like every day, if you want to give us a try, 7-day free trial, and a link here as well to try Rocket Scooter. If you guys enjoyed those positional data, institutional positions, it's something we all use every single day since we got in touch with Matt. Love the platform and would definitely recommend giving that a try as well. And that'll wrap us up here, guys.